Hi, good morning, everyone, and welcome to this month's question hour session. So, the next 1 hour, I'm going to attempt to answer questions, both which have already been given to us through various social media. We've got responses from hundreds of people. At the same time, we are also open to a live chat, and so live questions also we'll attempt to answer. So my colleague Shweta here has got the list of questions with her, and what we'll try and do is we'll segregate these around the economy, the markets, and investments. So I will try and attempt as many of these question answers as possible. So Shweta, I have had a look at the questions that have already come in. So what I suggest is I've got a brief gist of what kind of questions are there around the economy and the markets. So let me first, over the next 15 minutes, just give a sense of our thought process on where the world economy and the Indian economy is headed, and then what is the expectation from a market. That I trust would answer about 60-70% of those questions. And then anything that doesn't get covered during the course of my speech over the next 15 minutes, Shweta, maybe you can step in and ask those specific questions. Is that fine, Shweta?
Yes, sir, I'll do that.
Yeah, okay. So let me start off by giving a brief. I've looked at the questions, and lots of people are asking questions around with the world heading to a recession, what's happening with the Indian economy. And the second is, from the Indian economy's perspective, then the Indian markets are also showing a very unnatural resilience in this period when the world is talking about negative signs. So what is the situation around the economy and the markets? So let me first of all take you back a little bit in time. I think the current situation owes a lot to COVID. When COVID came on, there was naturally lockdowns and inflation, which early part of COVID inflation came down because naturally during lockdowns people didn't go and consume anything, and hence oil and other commodity prices, all of them crashed to their lifetime lows. However, since the advanced countries are essentially demand-driven economies and did not want to have an impact of the COVID in a very deep way, all of them resorted to boosting demand through three forms, right? First is through a fiscal stimulus. The US government, for example, gave away $3,600 to every taxpayer so that they would have extra cash in their hands to go and spend. The second is that the Federal Reserve and the ECB cut interest rates to record lows close to 0% so that people wouldn't feel the burden of their E.M.Is or whatever they wanted to buy. And the third was they pumped a lot of liquidity by buying back their bonds so much so that the world as a whole shot up its liquidity on tap to about almost $30 trillion, of which about 45% to $9 trillion came from the US. So combination of these three things meant that demand got stoked up and you saw demand side inflation come up. At the same time, the lockdowns have resulted in a lot of factories shutting down across the world, starting with China. And because of that, there was a supply shortage, notably of things like semiconductors and all of that, due to which the inflation further shot up, because this is what is known as the cost push inflation. Shortage of supply also leads to inflation. So a demand side pull and a supply side push meant that inflation in the US, for example, went up from about 1.5% in early January of 2021 to about 5.5-6% by the middle of the year. Right. At this time, the Federal Reserve, looking at the rising inflation, felt that this was very transient inflation, and hence they also chose not to do anything about it. Then the Russia-Ukraine murmurs started, the war started, and the oil prices and other commodity prices, because of the war which came in the first quarter of this year, started shooting up. So you had another supply side inflationary push, which pushed up inflation in the US to 8.5 to 9%. So this naturally caused an alarm. And in the middle of the current year, around June, is when the Fed decided that, hey, it's time to attack inflation. It's time to start talking about tapering down the liquidity, and it's time to start hiking interest rates. So they launched a very aggressive interest rate hike program over the next few months in a bid to tame inflation. And that, let me remind you, can happen only by cooling down demand, because supply side has been very little impact due to interest rate hikes. So the aggressive rate hikes meant that housing loan rates, for example, in the US, which had dropped to as low as 2.75% for a 30-year fixed mortgage, have now shot up to over 6%. So this cooling of the demand effect means that automatically now the commodity prices have started easing because the markets are anticipating that this slowdown would ultimately lead to a recession in the US and the advanced countries, and hence commodity prices crash. So this is a summary of the world situation where, due to starting with COVID and with the Russia-Ukraine conflict, the world, the advanced countries have been teetering towards a slowdown and towards a recession. And if you look at the current probability of recession in the advanced countries, it varies anywhere between 50 to 80%. So that's the status of the world, that because of inflation rising uncontrollably, they are forced to act very severely through the interest rate hike cycle and bring down the demand and hence cool inflation. But in that process, a recession will naturally happen. So that's the situation as far as the world economy is concerned, that pretty much the advanced countries are in a state where over the next year, year and a half, they are headed into a state of recession. Now, coming to India, right? What happens with India is India has an economy and a market, right? Now, the two things to remember about our economy is the heavy dependence on oil. 83% of our oil is imported, right? Second is that a large part of our economy is insulated from the world, apart from the oil dependence, because of the fact that we have the largest middle class in the world. We are trying to get business from China. That is, the world had treated China as manufacturing capital for the last decade or so, and Chinese cost of labor has been rising, Chinese labor supply has been coming down, and there was a big opportunity for India to take advantage. The government has launched the PLI scheme, whereby they're giving cash incentives for 5 years to get foreigners to come and invest in India. You would have read the headlines about Samsung, Apple, all the global majors now shifting production from China to India. So this gives Indian growth story a self-sustaining story where global manufacturers, MNCs, are coming to India to invest and take advantage of our labor supply and our lower labor cost. In addition to this, government has embarked upon a massive 100 lakh crore infrastructure program in order to make it easier for the foreigners to come and ship their goods from the factory site to the port or to the airports. So that is also giving a boost to the GDP. So as a result of this, India is on a cusp of what I would call as decoupled growth from the rest of the world, because these factors are not so sensitive. The other reason why I would use the word decoupled is because over all these years, while Indian exports have grown fairly strongly, from about 1% in about 2006-7 to about 2% now, the fact is that only 2% of the world's exports comes from India. So any slowdown in the world would affect 98% of the rest of the suppliers to the world, and only 2% will be the impact of India. As a result, the Indian economy is reasonably resilient. And so if you now look at the IMF's estimates of growth, they're expecting the world growth to go from 6% down to 3.5% in 2024. From 2021 was about 6%, 2022 is about 4% and next year 2023 it's down to 3.5%. In this, the advanced economies are going to go from 5% to 2.5% to about 1.5% next year. So the extent of the slowdown is visible in these numbers, but India is going from an 8% to about 8.8% to 6.1%. So in a world growing at 3.5%, in an advanced economy growing at 1.5%, India is slated to grow at 6%. So India is clearly going to be the fastest growing region in the world in terms of growth, and hence our economy, while this 6 may go down to 5.5 if the recession becomes very harder, it's not going to go down to 1 or 2. So India will head and shoulders still stand as the fastest growing economy in the world, right? So that's on the one side on the economy part. The second part of the inflation part, too, Indian inflation touched a high of about 7.5, is hovering around the 6 to 7%, and is slated to come down below 6 to about 5.5 or even below 5 by April, May, June. What is the reason for this? Two reasons here. The increase in oil prices, which happened during the Russia-Ukraine crisis and all of that, Indian economy got insulated there because the government was very, very careful about going and buying oil from Russia, which is about 25 to 30% cheaper than world rates, and saving about 35,000 crores in foreign exchange for our country. Second is the government also cut excise duties at the appropriate time. So the burden of the oil price was not fully felt by the consumer. And the third thing here is that the inflation in India is largely food inflation. Our CPI baskets contains 48% share from food. And as you know, food is a monsoon-dependent supply. It's not driven by interest rates or by imports. In fact, when wheat prices went up outside, India banned the export of wheat, so the domestic wheat prices did not rise as much as international wheat prices. So as a result, India's inflation has remained in the 6 to 7%, which has been our historic average rate of inflation. So for India, this inflation was not alarming. It is something that we are used to as a country. And with a good monsoon happening for the Kharif crop and for the Rabi crop, the news is that the reservoirs are 85 to 90% full. Initial data on the sowing of Rabi crop has been very good. So with plentiful of food supply, we expect our inflation to ease below 6. So our situation is very different. The third aspect here I would like to point out is the strength of our government's finances. The government used the leeway of fiscal deficit to do a lot of capital expenditure. But what has happened is because of our GDP growth sustaining, the corporate income tax, the personal income tax, and the GST all have been on a year-on-year basis grown between 25 to 35% as against estimates of between around 15% in the budget. So the fiscal deficit of the government of India is only at about 37% for the half year of the full year. So below 50 and wedged below the 85 to 90, which historically we used to spend our fiscal deficit in the first half of the year. So overall, the health situation of the government's finances is also much better than anticipated. So these good economic pointers, what happens is that when internationally, FIIs, now what is the coming to the markets of India? To the markets of India, the FIIs, actually, if you look at the Indian stock market's ownership, right, about 36% of the stock market is owned by the promoters of the companies. For example, Mr. Asim Premji owns Wipro shares, or Mr. Mukesh Ambani owns the Reliance shares. When you take the owners' proportion, which is 36% of the market, out of the picture, because their stock is not available for sale. So their stock holding doesn't come and affect the prices of stocks. You are left with 64%, which is available for the world to buy and sell. This is referred to as the free float market cap of the country. Of this free float market cap, 40 to 45% is owned by FIIs. Another 15 to 20% is owned by domestic mutual fund. The rest is spread among retail, non-owning corporates, banks, FIs, insurance, and all of that. So this 40 plus about 55% of the Indian stock market is controlled by the flows from FIIs and from mutual funds into the stocks. So what has happened is that if you track the FII flow, how it comes up and goes down as far as India, first of all, there should be a situation of reasonable interest rates so that people can borrow cheap to invest, the traders in the market. The second aspect is there must be plenty of liquidity available. Third is that India should look attractive as an investment destination. So from that point of view, if you look, there's about $30 trillion of liquidity. The much spoken about tapering of the liquidity has not happened to the extent that they had planned. They've kept the liquidity tap on. The second is interest rates, while they have shot up from about 1 to 4%, there is still enough advantage to invest outside of the advanced countries into emerging countries, given that their growth rates are much better. The third aspect, which is peculiar to India on flows into the market, is the fact that India's heavy dependence on oil means that not only is our country's fiscal situation dependent on oil prices, it's also that corporate margins are dependent, our currency is dependent, our inflation is dependent. But when oil prices rose, FIS naturally panicked as far as India is concerned and pulled out money. This happened between October of last year and June of this year. But once the Fed got hold of the inflation as a problem and decided to tackle it through rate hikes, the commodity and oil prices started coming down. So October to June, we saw that FIS pulled out about 2.5 lakh crores of money from the Indian stock market for fear of the impact of a rising oil price. But the actual fears didn't turn out to be true for the reasons I already mentioned. And hence, when July onwards, the commodity prices started coming down and oil came down from 125 down to 65. Yeah, I know it's went back up to 80 levels, but again, it's coming down. The dropping oil prices is the single biggest positive factor for an FII to invest in India. So of the 2.5 lakh crores that went down to 9 months, about 80,000 crores has come back between 1st of July and right. That's what has given the markets the support and the resilience. At the same time, except during the COVID phase, when the decline in the economic environment, the general feeling that there was a huge slowdown, the mutual fund investors pulled out money from mutual funds in the period 2020 up until March of 21. But once they realized that the markets were going up, because during that COVID phase, FII still put money into India because oil prices had come down. So FII hot money, or the money which comes in quickly based on short-term things, goes out during oil price rises, comes in during oil price correction. So during COVID, when there's an oil price correction, FIs put in a lot of money. So Indian stock market actually recovered. So retail investors who initially panicked on the COVID phenomenon found that they had missed out on a huge market rally. And they also saw that India was going through a V-shaped recovery of the economy. And that gave them confidence. And since the April of last year, consistently mutual fund investors have been giving money to mutual funds, and the SIP book of the industry has gone up to about 13,000 crores from about 5,000-6,000 crores a few years ago. So this solid support that is there from the domestic investors is also another cause that Indian markets have been resilient. So from July onwards, right, the FII selling stopped. October to July, there was FII selling, but the impact on Indian markets was less because domestic was buying. But from July onwards, both domestic investors and FIIs have been buying in the market. Hence, the markets have reached lifetime highs. So to that extent, the Indian stock market is also proving to be decoupled from the markets around the rest of the emerging markets. Hence, coming to the last aspect of the valuations, I would say that Indian markets, yes, do appear at a premium to the world market and to other emerging economies. The reason for that is simple: a strong growth story, and the fact that oil in a declining mode is good news for the Indian economy, and hence FII monies come in and support it. So this high premium that India charges for its stock market to international investors has been viewed by them right from 2006 as justified, because we are a growth country, and just like a growth stock gets a high P ratio, India as a growth country is getting a high P ratio. But the same valuations, if you look at from an historic India perspective, that is our own long-term average, and for the large caps, essentially, if you look at it, the long-term average P ratio hovers around 18.5 to 19, and today's valuation is hovering around 19 to 20. So we are trading at our own, around our long-term historic average, whereas in October 21, before the FII started selling, we were selling at a 23 forward P, 1 year forward P. When I mentioned about that 18, 19, it's all 1 year forward P. So it was trading in October at 23 PE, and way back in 2017-18, it was trading at 25 1-year forward PE. So the market has seen much higher levels than they have today. And from that perspective, from a long-term growth story, right, India continues to be reasonably valued as compared to its own historic P ratio. I will finally round out by saying that not all FII flows are subject to the oil prices and the short-term vagaries of currency and interest rates and inflation. There are sovereign wealth funds, pension funds, active long-term mutual funds, which invest based on the long-term growth story of our country, and that accounts for a significant proportion of the money that comes into India. And India's weight in the emerging market index is also an indicator, because passive funds will allocate by that weight. India today has about a 15.3% of the MSCI emerging market index, which means for every 100 rupees that gets to emerging market pool, India gets 15%. Active managers, of course, tend to take this up or down, but a passive fund will allocate 15 rupees out of every 100 rupees. This growth capital which comes to India from sovereign wealth funds and all of that is essentially betting on what I spoke about at the beginning today about the PLI scheme and the fact that India's growth is on a sustainable capex investment cycle driven growth path, which will then lead to a rise in our per capita income from its current levels of 2,300 to about 4,700, 5,000 by the end of the decade, 2032. We should reach $5,200. This rise in per capita income will lead to a rise in discretionary consumption, a rise in savings, and a rise in mutual funds contribution. So all things put together, over the next 10 to 15 years, Indian economy's nominal GDP growth is slated to grow at around 12%. The stock market over a long period tracks the medium-term growth. So over a 15, 20-year long-term cycle, Indian stock market should also be delivering you a 12 to 15% kind of a return, depending on how the nominal GDP actually shapes up. And active mutual funds are destined to beat the market because they are going to use research and diversification to add on the faster growing sectors and companies in those sectors, right? So to that extent, right, you can say that it's a good time to invest in equities from a longer term perspective in India. It doesn't matter whether you stagger your investments or you put lump sum if your outlook is a 10-year outlook. The other things is that, so then in that kind of a growth rate, some people ask me, how long will it take to double our money? There is a rule of 72 at play. So if I say 12% is the nominal GDP growth, even if the stock market tracks a nominal GDP growth over the next 6 years is when a doubling should occur mathematically, right? There's no guarantee that's 12% every year. It could be down some years, up some years. So overall, I hope this has given you a feel of what the world is headed towards. Where is India? Why is India's economy decoupled from the world? Why is India's oil dependence in this current scenario a good thing for us, both from an economy perspective as well as from a FII inflow? FII inflow strongly strengthens when oil prices decline. And in that context of a moderating oil price scenario, we do expect that there is about 2.5 lakh crores of money that was in India, which went out of India between October last year to June this year, right? 80,000 crores of that has come back from July to now. There's still 1,75,000 crores of potential money which had come to India in a declining oil scenario, which is still waiting outside, looking for the right opportunity, the right signals to come back in. So that underlying potential strength of flows from foreigners with the continuing SIP book in India, collecting the confidence of domestic retail investors in the Indian economy, should provide a sustainable flow into the markets and provide it a base. So while there will be volatility in the market, our level of volatility has historically been far less than world market volatility, and expect this situation to continue. So with that, I think I've addressed a fair bit of the questions around the thing that came up in that. So now I will hand over the floor to Shweta to pick questions which my broad speech did not cover, and also any live chat questions that have come up. Over to you, Shweta.
Yes, sir. We'll take a couple of the live questions now. The first question, sir, is why are people fearful of job losses? They cut down their spending despite having those free COVID dollars in their bank accounts. And in America, all these job losses in big tech companies, is it because of the actual economic downturn, or is it being done on the instructions of the government to curb inflation?
Well, the government's things to curb inflation are naturally expected to lead to a downturn in the economy, which is what is predicted. Notably, as I said, the housing sector accounts for about 42% of US inflation. So the US and the housing rates have gone up from 2.75% to 6% plus. So naturally, housing, fresh demand for housing will come under pressure, and housing is a big employment generator, and hence a lot of non-employed in the housing sector will face the threat of job losses. So in a way, the US government is responsible for it, but it is the slowdown in the economy that's causing it. And in fact, that's the thing which the government wants to do, because that's the only way that inflation can be brought under control.
The next question, sir. In the present scenario, should one invest in a large cap fund?
So I would say that while a certain proportion of your money should be in large caps, given the fact that consistent FI buying gives support there, I would say the growth story of India from an investment consumption cycle is largely a mid and small cap story. Whenever the domestic economy does well, it's mid and small cap, it tends to outperform in terms of earnings because they are all domestically focused. So I would say that for you to choose a flexi cap fund or a multi cap fund would make better sense than to put your all your money into a large cap funds, because they do take their share of large cap. For example, flexi cap funds typically have been keeping between 50 to 70% in large caps. Multi cap funds have to keep minimum 25%, but they end up placing 50% plus and 50% in large caps. So I would say that a multi-cap, flexi-cap kind of a fund was a better bet than a pure large cap, because you will get the benefit of good large caps as well as good mid and small caps in such a portfolio.
The next one, sir. With debt yields going up with the interest rate hike, are we already somewhere near the peak, or is there still a way to go?
What is that with debt rates? Is it?
Yields.
Debt yields. So I think that international yields have factored in that the Fed will peak around 5. Some are at 475, some are at 525 in terms of where they will go. So the yields already reflect that. So I don't think international yields are likely to go any further higher than this, because as the US interest rate hike takes effect, you will tend to feel that most of the market feels that once they hit that peak, for about 6 months, they will stay at the peak and not rise. And then by the end of the year, they're expecting rate cuts to happen in the US. So I would say internationally, those yields seem to have peaked. Coming to India now, see in India, the RBI's interest rate policy at the short end is largely a currency management tool as opposed to an inflation management tool. So you will see that banks who typically, use the RBI rate as a reference rate have actually increased their deposit rates by about 30-35 basis points, but they've increased lending rates by about 100 basis points. So clearly they are using this opportunity to widen their margins. So from a yield perspective, I would say that I see RBI as stopping their rate hike cycle by the last quarter of this year. Right from April onwards, I don't see them in an ability to hike rates, because actual inflation print should come around 5%. Only about 6 can they hike rates. So I don't see RBI getting into a rate hike cycle. Now, domestically, yields on corporate paper should actually go up a little more. The reason I'm saying that is bank credit has been very low due to the post-COVID crisis, especially corporate, because corporates haven't invested in capex for over a decade now. So, but as corporate demand picks up, the demand for money will mean that the corporate borrowing rates could rise, and some of them will get reflected in debt yields in the corporate. So GSEC rates may not rise much. They are at 7.5%, will likely remain. But I do accept that corporate borrowing rates, as demand for money starts exceeding supply, should rise a little bit. So I would say another 50 basis points rise in medium-term yields could be on the way. You could, expect that to happen.
So will there be any economic growth impact vis-a-vis around the Lok Sabha election outcome?
Well, I think that Lok Sabha election are due middle of next year. So we have a budget this year, which is your last non-election budget. The next year's election budget, however, could be constrained by the fact that if the elections are announced, the budget can't announce any populist measures, right, legally. So to that extent, even in this budget, I do expect the populism to creep in, right? So from that point of view, that will mean more money in the hands of people, right? So economic growth will actually get boosted in a pre-election year, because a lot more money is being distributed out to people to create a feeling of well-being, because happy people tend to vote in favor of the ruling party. And inflation is another concern which voters feel. So there will be attempts to keep inflation definitely under control. So to that extent, I would say that India should actually lead to a higher growth in the run-up to the election, because of the liquidity being primed up in the economy.
The next one, sir. What will happen with Indian tech stocks if inflation in the US reduces soon?
So I think the US tech stock story is not related to inflation. It's related to the slowdown. So inflation is a second degree effect. So after inflation, because of high inflation, there are interest rate hikes. These interest rates are expected to cool down demand. If cooling down demand is to lead to a slowdown and to a recession. So in a recession, if they had planned during COVID to do a massive revamp of their IT infrastructure, today they'll say, hold on, my sales growth is coming down, my profits are likely to come down. Is it the right time to go and invest heavy capex in IT? Let me postpone it. So that's the negative impact of a recession, which is being felt today in IT stocks. So if inflation starts coming down, right, and the US eases off the interest rate, then there is a view that it could be a soft recession in the sense that the markets have quickly responded to Fed's interest rate hikes and inflation has come down, economy is coming down, they are likely to pause and revive the economy. So IT stocks are very sensitive to that. And to that extent, I would say that what's happening in the IT sector in terms of the prices correcting of the stock prices is also the fact that IT became a growth sector during the COVID phase because there was a perception that work from home and cloud computing and Internet of Things would lead to a huge, boom moment for IT, which has not lived up to that because of the fact of the Russia-Ukraine crisis. So as a result, there's a correction happening in the valuations to take away that fluff of a very super high growth sector. Is now going to become a normalized growth sector. Until valuations come down to that level, there could be some pressure on IT stocks. But once they come there, IT is a core part of every portfolio. IT is not cyclical that it goes down and comes up. There's a stable, steady rate of growth in the IT sector. And hence, I would say that there is a little more fall maybe in the IT sector stocks, but after which they should stabilize and they should continue to get buying support because FIIs tend to like IT sector stocks because they are very clued on to the users of those IT companies' services and how their business is going. So holding that for them is a kind of a hedge against the economy. So to that extent, IT I would see a bottom pretty soon and then see stable thereafter.
The next question, sir. China is seeing an increase in COVID cases. The government is, planning lockdowns, but people are resisting it. What are your views on China in the near future and its impact on the rest of the world, including India?
So it is the fact that China has been very harsh as far as COVID measures, and probably people are getting frustrated, and that's spilling over into the streets. But I think that they are very worried about the longer term impact of a resurgence of COVID. So it's a balance between people's unhappiness and the long term economic growth. So to that extent, the Chinese government seems to be very clear in its path. This unrest could lead to some amount of nervousness around the China as an investment destination by foreigners. Uh, China actually, I don't see going through the slowdown because it is already slowed down tremendously. Next year, it's expected to grow at about 4.5% compared to India 6%. But that should be sustainable. I don't see China further slowing down. I think these unrest, they are an iron hand government. They will put these down ruthlessly and bring that situation under control. Chinese economies for slow down to the extent of 4.5% that they are there, they are will be stable around that for next 2 to 3 years, has already been factored in by the world. So I would say Chinese stocks have corrected a lot. So there's stability to around 4% for Chinese growth will mean that Chinese stock market should having corrected a lot, could see a bounce back, in fact. But the impact of this slowdown on the rest of the world, right, unless China loses control over COVID, and because of COVID there is a slowdown, then the world will get affected. But since they are taking very strong actions to control COVID, I would say that the impact of any slowdown from China is not an imminent threat. It's more, like I said, it's the political unrest which is a worry rather than the economic unrest.
The next question, sir. If our economy is growing, why isn't it translating into job creation?
The reason that job creation in India is the gap in skilled labor. So the PLI scheme, for example, is getting a lot of technological companies here like Samsung and Apple. So you need skilled engineers and the like to do that. So the gap is in terms of whereas India's workforce is still unskilled and lying in the farmers, and there are migrant laborers who, because they don't have enough jobs in the farms, are migrating to the uh, urban areas and becoming carpenters, plumbers, and So we are still at the low end of the scale in terms of skilled workers, and a housing industry boom tends to give employment to these low skilled laborers because the people who lift the sand and the cement and those kind of activities. So I would say that for the economic growth to translate into greater job creation, we have to wait for these PLI schemes to really pick up on the ground. Right now, they're still investing to create those factories. As those factories come up and running, right, you're also going to face with the world going into recession. So those factories may not be able to step up to that much full capacity so fast till the world comes back into a recovery mode. So it will take a bit of time to see a big dent around the employment data in India. It will increase, but we have to give it a bit of a time for it to really translate at the ground level. But it's just, that's why this government has got the Skill India program, where they're trying to skill people to make sure that there are enough labor in the right areas.
Next one, sir. Could you please talk about the performance in general of Sundaram funds and how they compare with other funds with a focus on equity funds?
So I would say that over the last year or so, there's been a strong turnaround in Sundaram Mutual's performance. In the early part of the COVID period, our funds were a little bit under pressure because of the kind of sectoral calls that were taken in a COVID scenario. They did not play out. However, since the beginning of this year and the appointment of Mr. Ravi Gopalakrishnan as the new CIO, who came over from the principal mutual fund which we acquired, and his team coming over with the some revamping in our existing. From the 1st of January, there's been a strong across the board performance improvement in almost all of Sundaram's equity schemes. Notable here in terms of the history is the mid-cap fund, the tax saver fund, which was the Sundaram Diversified Equity Fund, which were among those funds which, after a period of very good performance in the period from 2015 to 17, started going through a long period of underperformance. Today, I'm happy to report that both the tax saver and the mid-cap fund are up in terms of quartile, in terms of the quartile 1 and 2 on a one-year return basis, which means they are in the better half of the industry. In addition to that, Sundaram has also been focused on its non-mid-cap oriented funds, like the Balance Advantage Fund and the large and mid-cap fund, and those funds also, if you see, have improved tremendously. The Balance Advantage Fund, in fact, is in quartile 1 or 2 over the period of the last 4 or 5 years. So that's an important dynamic asset allocation category. And then I will also point out that one of our launches in the year 2018, the Services Fund, which still remains a unique fund in the industry. No other AMC has a Services Fund, has been one of the best performers to compare it within the flexi cap space, because roughly it's a flexi cap fund with about 50% in large caps and 50% in small caps, has again been a very top performer. So I would say that Sundaram's performance. And then in the hybrid category, we have our equity savings fund, which is again a very good alternative to short-term debt instruments because of the equity taxation, but which operates roughly with a less than 50% in equity and the rest in arbitrage and debt. So I would say that across the range, you'll find that most of our funds today are beating the benchmark, as well as in the top half of the industry on a one-year basis, and many on a 3 to 5 year basis too. So I would say that if you take a look at our fact sheets, you will realize that there's been a strong across the board improvement in Sundaram's equity mutual fund performances.
So we have a couple of questions on the aggressive hybrid fund, on whether we have a small cap fund, and on rural as well.
Yes, I did see those questions. And on the aggressive hybrid, somebody had mentioned why is the performance not great. So I think that you will have to look at it and say that it has delivered a very good performance of double-digit returns over the last 5 to 10 years, if you look at it, which, given that hybrids are essentially competing against the fixed deposits as a safer alternative to investing into equities, I think has done a fairly decent job. Because, mind you, with equity taxation, these numbers are actually almost double of what FD returns would have given you. The second, perhaps you should look at is, have you been investing in the dividend option of the fund? In which case, the NAV may not have grown much, but because we've been consistently on a monthly basis paying out an annualized dividend yield of close to 10 to 11% to the investors. So those who have chosen the dividend option would have got the money monthly on their bank account as a cash. So I think that if you then take the quantum of that money that you've got and how you've deployed that, you will find that the fund has indeed done very well. And in fact, in terms of quartiles, it continues to remain in the top quartiles of the industry. So I would suggest that maybe it's because you're in the dividend option, you're not seeing the NAV growing, but monthly you have got the cash back in your bank account. On the small cap fund, yes, we do have a small cap fund, which is about 2,000 crores inside. It's called the Sundaram Small Cap Fund. It was earlier named as the Sundaram Smile Fund. After the merger, it got merged with Principal Small Cap. It's again a fund which has beaten its benchmark very, very strongly. And I would encourage you to take a look at that fund. We do have a small cap fund. Was there a third fund that was there in question, Shweta?
It was just rural, small cap, and
Yeah.
aggressive.
So the rural fund has been refashioned and renamed as a Sundaram Consumption Fund. So initially when it was launched as rural fund, it was building on the rural theme. Now we find that urban consumption is also growing and rural as a theme has become incorporated into a lot of companies' charters. So from that point of view, you felt that in today's day and age, because we have a very strongly bullish view on discretionary consumption as a way forward for our economic growth, we believe that refashioning this fund as a consumption fund would serve it better. So we've done that. I think the notice went out and now it's called the Sundaram Consumption Fund. I think it's been also performing fairly well after its refashioning, and it will essentially play on the consumption theme that's growing very fast in India.
The next question, sir. Can we expect any NFOs in the near future from Sundaram?
Nothing has been planned as of yet. Right now, we've just completed the FlexiCap NFO. Our focus is on making sure that it performs well and lives up to investors' expectations. Most of the categories that SEBI has allowed for the industry have been filled. Any future launches can happen only around a thematic or a sectoral fund space. As things stand now, we are not have any plans for an NFO in the immediate future. We will let you all know as and when we come up with an idea which we think has a long-term sustainability and can stand on its legs.
The next question, sir.
Yeah.
We expect the rupee to depreciate further given that crude prices are cooling down and the RBI may choose not to deplete forex by further buying Indian rupees.
So, as I mentioned, that oil prices are falling down, right? So, the oil price is falling down because of the ongoing expectation slowdown come recession. So, when a slowdown come recession happens, right, which means that by the end of 2023, we are expecting that US interest rates would have finished their hike and the pause and would be in a declining scenario. So what has happened is the dollar, which was continuously strengthening ever since US interest rates were being hiked, has now started to weaken, right? So when the dollar weakens and the pressure on the rupee to weaken comes less. RBI has done a fabulous job in managing the rupee's depreciation only to round about the extent of the dollar's appreciation. That way, neither exporters nor importers get affected because if it weakens more, then it hurts our imports. If it weakens less, then it hurts our exports. So RBI has managed it well. So for RBI's theme will continue to be to manage what is known as the REER, the real effective exchange rate of the rupee. Why do I say that? Because it's not just the US dollar interest rate, the currency rate the RBI is worried about, it's the weighted average performance of the rupee against a basket of currencies. Now, there's a small 7-country basket which contains all the major economic currencies, and then there's a larger 30-40 country basket which is tracked over a longer period of time. So RBI tries to make sure that the rupee is balanced in that the RER doesn't go overweight or underweight. So to that extent, RBI has done a very good job. So, but in a scenario where now we see that with oil prices declining and a recession looming, and you're going to see the dollar declining, the pressure on the rupee to depreciate will be far less. So RBI's problem will be the opposite. It is to prevent too much of a rupee appreciation because we want to maintain that balance. So I don't see that in the short run, the pressures on depreciation are going to be very strong. And in fact, if FII flows of about 1.7 lakh crores are expected to come in, FDI flows are continuing to flow into India, you will see a lot of flow-based support. NRI deposits have also been increasing because the RBI announced measures which are given a better interest rate to NRIs. So there is enough flows of dollars coming in. And while Indian economy's growth will mean the trade deficit will widen, bring pressure, we think the inflows from these FII, FDI, and NRIs would help to balance out the current account deficit. The trade deficit plus invisibles is the current account deficit and keep that reasonably under pressure. So I don't expect any undue devaluation pressure given that US dollar is probably past its hiking peak and now is headed on a decline, slow but steady decline. So pressure on the rupee, I would expect it to ease over the next year and you could see a rupee appreciate from its current levels in the short term.
The next question, sir. Given that markets are booming right now, is it a good time to invest in commodities like gold and silver? If yes, what percentage of our portfolio should they be?
So I would not give an answer on general commodities. Let me answer gold and to some extent silver to the next one. So gold as a investment is something that provides you a hedge generally against inflation, against war, and the like. But generally, what has happened in gold's lifetime is that while it's perceived this way from a retail owner's perspective, the big players in the gold market are now the sovereign wealth funds like China, Norway, who hold a significant proportion of their reserves in gold. And the choice for them is gold is a alternative to the US dollar, right? So when the dollar strengthens, which is because US interest rates have risen, they look at putting their money away from gold into the dollar because not only they get the benefit of an appreciating dollar, they also get a yield of whatever 3.754% on their investments. So gold tends to get sold when a dollar appreciates. When the dollar starts weakening, then they fear that there will be capital erosion of their investments in the US and they tend to then put money into gold. So this interplay between gold and the dollar is what is determining this. I just finished explaining that I see the dollar on a weakening cycle consequent to a recession in the US. So from that point of view, I would say that some of these sovereign wealth funds would tend to reallocate money from dollar away into gold. So gold, if you see over the last 1 month, has seen a small bounce back in prices. And I think that that will continue for some time. So to that extent, to me, gold is a safety hedge in your portfolio. It's also for India a currency hedge because of the dollar. So I would say that keeping 5 to 10% of your allocation in gold and paper gold, like through gold ETFs and gold savings funds, is a good option. There's also the government of India has a scheme where they give you about 2.5% interest on gold. So which I think is a reasonably good return in addition to gold price appreciation. So I would say that keeping 5 to 10% of your overall investment allocation in gold and silver is related to that. So when the silver has a little bit of manufacturing need also there, silver is used as a raw material in a lot of places. So that, however, will be a less of a play because in a commodity deflation scenario, that demand for silver as a raw material will also come down. So I would prefer gold, which is not linked to any usage, but purely a sentimental reallocation of capital drives the price of gold up or down. I would say the situation for gold is slightly favorable, and hence allocating 5 to 10% of your portfolio to gold would not be a bad idea. I would recommend that you keep that.
So we have a couple of stock specific questions and some about competitions funds.
So neither of which I think I would be fair to answer. Regulation do not permit you to talk about stock specific questions, and I think it's not fair to expect me to answer competitions funds. So kindly excuse me from those type of questions.
The next question, sir. As a retiree, how should I invest my pension?
So, first of all, when you're talking about invest your pension, it means that you have other source of income to take care of your regular consumption living needs. With that assumption in mind, because you're talking about investing your pension, so then what is the purpose as a retiree to invest your pension? It is to leave a legacy, a financial legacy for your family, for your grandchildren, right? So to that extent, I would recommend that you first of all, whatever investments you make them a nominee, so that after your passing, that's not an issue for them to go running around to try to get that money. So first is do a nomination in favor of who you would like that money to go to. Second, given that they would probably be in their early ages now, say below 10, and they would look at this money in a 20 to 30 year time frame of use to them, you can allocate this money into the flexi cap, multi cap kind of buckets, because Indian economy goes through its phases. At certain times, the flows into India goes through its phases. So flexi caps are the ideal kind of product which is able to reallocate among large, mid, and small caps, where the mid and small caps essentially play on the India growth story, and the large caps tend to provide a safety element to it from volatility and also tend to benefit from FIS turning positive towards India. So the flexi cap is a wonderful product for you all to evaluate, and multi cap has got certain rigidities around how much in small cap, minimum 25% small cap, minimum 25% mid cap, which over the long term could actually deliver better, because that consistent allocation to small cap and mid cap will mean that stocks get bought when they are corrected. So the buy low, sell high comes into play. So I would encourage you to look at a multi-cap, flexi-cap kind of an SIP for your pension over a 15 to 20-year period with the nomination in place so that when they need the money, there's a nice corpus that they can look forward to having.
Next question. So, in which scenario do we plan to switch mutual funds?
So I think the switching of mutual funds, first of all, there are two types of switchings, right? There's a debt to equity switch, which is what an STP does, which is that you can do an SIP in a mutual fund or you can park your lump sum into a debt fund and then do an STP from a debt to equity. So that's just a mechanism of parking your money in the short term in a debt fund and gradually buying equity for those people who feel that putting all lump sum at one is too risky. I'd rather stagger it given the volatility. So that's a call you can take. But switching between equity schemes is generally not something that I would advise. I would say the amount of homework you do through your advisor or through your own research into the fund at your choice, right, is important. But once you do that, you have to back it. The fund may go through a short period of underperformance, but over a medium term, every fund manager has his eyes on the market, does his research. So over the medium term, I would say there is a general reversion to mean in terms of mutual fund performances. Some will perform very high for a period, some another high. So I would say that it's important not to get disenchanted. If you've done a research and made an investment in a particular scheme, is to give that scheme 5, 10, 15 years of time and to deliver returns. So I would say that equity to equity switching indicates a hot button approach where you invest, you find over 3 years it has not done well, now you want to switch to another, you're jumping boats. But by doing that, you're not giving yourself that consistent long-term compounding a chance to work for you. So the difference between a performing fund and underperforming fund will narrow down over time. So I would recommend that equity to equity switches be done on the rarest of circumstances, maybe if a fund manager quits and so the nature of the fund is undergoing a change. If there's been a merger, so that old fund is now a new fund in a completely different context, then you can, in consultation with your advisor or distributor, look at it and say, hey, this was the fund I invested in, it's not changed to this. Is that something that fits into my portfolio? And then do it. Overall, the reason I'm saying all of this is that I would recommend that every investment you make in every scheme, you link it to a particular goal. Whatever be period of time, whatever be the logic, write that down and stick to the scheme. You will find that it will deliver to your goal over as long as it's a long enough period. So since then you're going goal-based asset allocation, the whole switching of funds, right, is a very rare occurrence, which can happen, like I said, if it's really been disastrous in performance, the change of fund manager or a merger of the scheme or some such extraordinary event.
The next one, sir. Why were investments stopped in diversified equity fund?
The reason they were stopped was that when we bought Principal Mutual Fund, they had a tax saver scheme and Sundaram had a tax saver scheme. We named it Diversified Equity. They called it Principal Tax Savings. So we had a choice to choosing to retain only one of them from a regulatory perspective. We couldn't merge the two because there's a 3-year lock-in for investments, right? So somebody who's from a taxation perspective of merger, it gives you a benefit, but you can't redeem that unit before 3 years. So we can't do the merger. So what our plan for that fund is that when it completes 3 years from the date of the merger was, I think, 31st December of last year, 1st January effectively this year. So 1st January 2022 is when the merger schemes generally happen. So 1st January, we stopped fresh investments into this because our plan is that in 3 years from there, that is 1st January of 2023, 24, 25, right? When the 3 years gets completed, right, we will merge that diversified into the other tax saving fund, which is the old Principal Tax Saving Fund, now renamed as Sundaram Tax Saving Fund. So we had to stop inflows. Either we had a choice to stop inflows in that or stop inflows in the Principal's Tax Saver. We felt that the Principal's Tax Saver had demonstrated a better performance and the thing. But that being said, both the diversified equity and the Sundaram Tax Saver are being managed by the same fund manager with the reasonably aligned portfolios, and both are doing well. So I would say that if you had wanted to invest in diversified equity, but you're saying that it's stopped for fresh investments, I would say you can look at the Sundaram Tax Saving Fund now, which is roughly similar in portfolio, very good in performance, and can be a good long-term wealth creation portfolio for you.
Thank you, sir. In the interest of time, we just take two more questions.
Sure.
One is, what is your view on the auto sector long term, especially considering EVs?
So I think that the auto sector, we are very reasonably bullish on that in the long term, but I must tell you that auto is not one monolithic sector, right? So if you take the potential for EVs, so roughly the auto sector, I would divide into four components, right? There's an auto components, which is an export-oriented sector, right? Parts of auto. Then there's a two-wheeler industry, there's a car industry, there's a commercial vehicle industry, trucks and the likes, and then there's a tractor industry. All these four operate on very different dynamics. So the two-wheeler industry, and I would say the entry-level car industry, is largely a rural India phenomenon, where people are coming over from buying their first two-wheeler to then migrating to a small level car. So that's a rural demand, bottom of the pyramid demand story, which in India, I think is going to be a growing story because of the rise in per capita income. The passenger vehicle car scenario, right now, if you see registrations have dropped because there's been a huge semiconductor shortage in the past and there's a pile up of demand. But as an aspirational value, the car has tremendous potential in India. And I think the SUVs coming in has made a big difference because these are large, reasonably priced cars for the family, right? So we see that as a real strong part of the discretionary consumption story, right? When it comes to the commercial vehicles, that's a part of the logistics and transportation, which is essentially a very cyclical industry. It goes through periods of excess capacity, then short capacity, the wild swings, right? Because it's linked to the capex cycle. You need a lot of transportation of cement and steel and oil and all of that during a capex boom. And then you need transportation to transport goods in the consumption. So the cyclicality today, because we've come through the COVID lockdown in a short-term phase, is going through a kind of recovery, V-shaped kind of recovery. So our outlook for the next few years for the commercial vehicle segment is also very positive. Now we come to the tractors part. Now on the tractors part, it is a very seasonal element. First, rural people have to have good harvest and get money in their hands, right? So when monsoons are good, tractors will be good. When monsoons are down, everything. So tractors tends to go through the monsoon cycle in terms of demand. So you got to keep watching that as a trend. On the final one, on the auto components, it's an export-oriented sector largely. And so because of that, the world recession would mean that there could be a slowdown in terms of demand for auto components. So then when you look at it segment-wise, clearly you can see from a discretionary consumption, passenger vehicle space and a commercial vehicle space, which are significant parts of the overall auto industry, we think that the auto industry is in a good shape to deliver well because India has a kind of auto hub, lots of good quality auto companies, the manufacturing side, auto component suppliers. So we are in a sense, for the world, we can be a big supplier of automobiles in the coming decade. The EV part of it then will come. It's not going to affect tractors. It's not going to affect commercial vehicles. It's not going to affect the auto export, that is the component part. Where is it going to affect? It's going to affect in EV, the bikes, e-bikes, and in cars, right? Now, in cars, the initial auto-related thing is the creation of capacity for EV, both as a plant manufacturing vehicles, for which there will be a lot of capex, plus the charging infrastructure that's needed over the country. So if you look at a broader auto component, this EV development is going to give a lot of opportunities and those companies which are ahead of the curve in terms of EV implementation are probably get a higher valuation from the stock market. So we see that EVs as opposed to ICE, internal combustion engines, right? It's more of a longer term story. Over the next 3 to 5 years, I don't expect EVs to become a huge market share, but their growth rates will be fantastic. They will be growing at double-digit growth rates in terms of, they'll be the fastest growing segment, but as a share of the total pie of the auto industry, I think by the end of the decade is when you can see a significant dent being made in terms of the overall population of vehicles where EVs form a part. So it's a longer term story under development. Market will give its valuation. So from a tactical deployment of money into EV related auto companies, it will make good sense from that point of view. But overall, the fundamental landscape around India, right, I think remains one of a commercial vehicle driven by diesel engines still.
The last question for the day, sir. When can we expect a Sundaram AMC IPO?
Well, when we do an IPO, we do an IPO when we need money. I think the company is sufficiently capitalized to finance its ongoing operations. So IPO of the company is a decision that the group has to take in terms of the overall. I don't see that we have any current plans to list Sundaram AMC because we have adequate capital to finance our growth in the coming years.
Thank you, sir, for taking the time out to answer these questions.
Thank you. All the very best to all of you.